Welcome to it. Vehicle and taxi financier Transaction Capital reported that its earnings are growing in line with historical growth rates, and as a result, it hiked its full-year dividend. The company did note that even though commuter activity is increasing in South Africa, it is not anticipated to reach pre-pandemic levels in the short term. The macroeconomic headwinds continue to place pressure on minibus taxi operator profitability, causing finance and insurance installment affordability constraints. For more, we are joined by David Hurwitz, who's the CEO of Transaction Capital. David, thank you so much for your time. In this environment of rising fuel prices, inflationary pressures, as well as increasing interest rates, let's look back at the year that was for Transaction Capital. How would you characterize that?
So we're very pleased with the year. First of all, thank you for having me on the show. We're very pleased with the year. We think that Transaction Capital has done really well. Our growth rates are again in line with the growth rates that we saw since listing. Our CAGR since listing has been a 7% growth in headline earnings per share. We've achieved the same number again this year. So we're very happy with the result. Very strong performance in We Buy Cars, still growing volumes, still increasing finance and insurance penetration, still expanding geographically. Still doing much more in terms of online lead generation, online marketing, and online e-commerce sales. Fantastic performance out of Newton, which has been rebranded from Transaction Capital Risk Services. There we've expanded our offering, not just to provide collection services, but also other customer experience services. So customer care, customer retention, customer onboarding, and we're doing that in new sectors and in new geographies. So about 10% of our profits from that division came from providing non-collection services to corporates in the UK, but using our South African infrastructure to deliver. And there we're very proud to be creating employment and youth employment. Created about 600 or just under 700 jobs for the youth. So very, very proud of that sustainable employment creation in South Africa. But the one that suffers is still SA Taxi. During COVID, we had lower commuter mobility. Then we had an environment and still have an environment with high fuel prices. During this period, Toyota again increased the price of the vehicle, which makes it more difficult to afford. And then over and above all of that, what we've also seen now is the floods in KZN, which had the Toyota plant closed for from April through to August. And you will know that, the car of choice in this industry is the Toyota minibus van. And of course, it made life very difficult to, with Toyota being closed, we just couldn't find product to finance. So that division still having facing headwinds, but all in all a great year for TC.
Let's focus in on that division. I mean, you did mention that that impact that the flood had on the Toyota plant. How have you had to navigate that in terms of thinking of new ways to be able to still operate that part of the business?
Yeah, so there are two things we had to navigate. I mean, our business, we pride ourselves on being entrepreneurial. We are founder-led, highly entrepreneurial, and we don't just accept the environment, we always try and trade through the environment. What we did is we shifted more and more of our originations towards what we call a QRT. QRTs are quality renewed taxis. So this is a taxi that we have repossessed or bought on auction. It's a second-hand taxi. We rebuild the taxi in our own refurbishment facilities. And then once we've rebuilt it and we're comfortable with the mechanical robustness of the taxi, we can then refinance and reinsure that taxi. So we tilted our loan origination process more towards QRT and away from new, as we could not get our hands on, as supply was disrupted. And that helped us, but it wasn't sufficient to supplement the loss of new vehicle loan origination. Other things that we've had to be, where we've had to be very nimble, by example, is I spoke about affordability constraints with high fuel prices and high vehicle prices. What we've had to do is extend the term of our loans to make the monthly installments a little bit lower and a little bit more affordable. We've had to pick our credit more selectively against good operators. And then QRTs again are good because a QRT is cheaper than a new vehicle and hence more affordable. So there are quite a few things that we've had to kind of handle in this division. We guided to the market that we would be down, and as you saw, we were 26% down in this side of the business.
In terms of, going forward, what will you and the rest of the team be focusing on, say, over the next 6 months or so?
Still in SA Taxi or across the group?
Let's look at across the group.
Yeah. So, I mean, first of all, in SA Taxi, what we have done is we've built a business to be able to provide finance and insurance into the second-hand vehicle sector. SA Taxi over 20 years has done very well to build a sustainable business of providing finance and insurance into kind of a niche minibus taxi industry with 250,000 operators. Now with the acquisition of We Buy Cars, where we are the largest retailer of second-hand cars in the country, we've been able to use all of the capabilities we have in SA Taxi to provide finance into the underserved second-hand or used vehicle market. So that's one area where we think as the minibus taxi recovers over the next year or so, we'll have another growth vector within the SA Taxi segment. In Newton, as I've spoken before, we are focusing heavily on broadening our offering and selling our services to other corporates in other geographies, most notably Australia, the UK and the US, but using our low-cost RAN-based infrastructure to deliver or fulfill on those services. And that's giving us higher growth. That business grew earnings by 28%, and we feel that we can continue growing earnings in the 20s, driven by that strategy. And if you look at We Buy Cars, I think I've touched on everything there.
Yeah.
The big drivers, it's more of the same. We continue to take market share through geographical expansion, through things like more online lead generation and online trade. And we continue to be the trusted and best known brand in the second-hand market space, which again brings us market share. We've got a market share of less than 10%.
Right.
And, I'm hoping that in the medium term we can break into the 20s.
All right, David, thank you so much for making time to chat with us this afternoon. That is David Hurwitz, who's the CEO of Transaction Capital. We're going to take a quick break. When we come back, we'll look at your markets news. Your markets news now. The rand strengthened in early trade as the dollar fell on global markets appetite. And of course, that risk that we did see boosted by policy moves in China. Some Chinese cities have begun cutting routine community testing days after China announced an easing of some of its coronavirus measures. And Beijing has announced support measures aimed at boosting liquidity in the property sector, a pillar of the world's second largest economy. Meanwhile, European markets, they're muted, and that sentiment comes after a choppy session in the United States overnight, led by comments from the Federal Reserve leaders Lael Brainard and Chris Waller about interest rate hikes. Locally, personal storage provider Storage Property and We Buy Cars owner and taxi financier Transaction Capital reporting their results. And you would have caught that interview in the last bit just before the ad break with David Hurwitz. But to talk to us about the latest, we are joined by Makwe Masilela from Makwe Fund Managers. Makwe, thank you so much for your time. I mean, let's get a sense of your understanding, or rather your assessment of global market sentiment right now, given some of the comments we're hearing from the Federal Reserve leaders, as well as this hope about what's happening in China.
I think the sugar rush is fading, though the mood is relatively positive, and all because of those mixed comments coming out of the US Fed officials, and because we are worried exactly what is it going to be the path going forward when it comes to interest rates. But I think we're getting a boost as well. Number one, we've seen the tension between the US and China is like cooling off, and also we're optimistic that, listen, China might be coming with some more growth-friendlier policies going forward. And as you mentioned in your intro as well, some of the measures when it comes to COVID, I think they're kind of encouraging, and already we've seen the plan when it comes to their struggling property sector that are trying to help that. But of concern as well, we've seen that China is continuing to slow down. Look at their October retail industrial numbers, they missed expectations. And also you look at Japan, their third quarter GDP was worse than we expected.
Speaking of that sugar rush fading, and then you take into consideration last week's US CPI data and the comments coming out of the Federal Reserve leaders, going into the December Fed meeting, are you expecting 50 basis points, or are you thinking they might continue with putting their foot on those brakes?
Most probably they'll go with a 0.5% because we've seen so far that even if we don't have to read inflation numbers from just one number, but I think generally you just have to pause and see the impact of all these increases that we've done before. So yes, they've given us enough when it comes to 75. I don't think they can continue at 75, let alone that we've seen a much lower inflation number that we've seen last week, Thursday or so.
We had David Hurwitz a little bit earlier on, the CEO of Transaction Capital. When you look at their financials, were there any standouts for you?
Definitely. I like the fact that you look at taxi finance as well, SA Taxi. The guys, other than just financing the taxis going forward, they're also financing public transport modes. They're looking into, or they've started financing the private used car vehicles, and it makes sense. I mean, if the guys are the majority shareholder of We Buy Cars, and We Buy Cars itself is their largest business, then it just makes sense that whoever is buying cars from there, they need to get the necessary finance instead of them giving over to other guys. With the taxi itself, we know that for the fact that community activities have reduced, meaning they're not yet back at the pre-COVID levels. That unfortunately continues to affect the profits of the operators, and as a result, the guys continue to struggle when it comes to pay their monthly installments, including insurance. But generally, I think the guys, they still have a chance going forward, and not forgetting that also that Toyota factory closing down affected their loans and advances.
Let's shift sectors a bit and look at the telco sector, because yesterday you had the trading update from Telkom and then you had interim results from Vodacom. What's your sense of the telcos right now, whether it's MTN, Telkom or Vodacom? Do you have a preference?
Yeah, I think I'll go with MTN. Number one, we know besides that MTN is the biggest boy, but you look as well at their PE is much better than that one of Vodacom. Yes, Vodacom continues to be a very good dividend payer. My biggest thing here is going forward, telcos will be making money out of fiber. So Vodacom, they've already done their deal, and we hope Sanity at some point will prevail. Then MTN will start talking to Telkom so that they can also increase their mileage when it comes to fiber. So I think MTN still has a good chance to be able to grow further than the way it is now.
The one thing we are seeing, especially as we look at the energy constraints in South Africa, is that a lot of the JC-listed companies are spending quite a lot of money to keep the lights on, to keep services up and running. How concerned are you when it comes to this trend we're seeing, where we're seeing the lost trading hours from the retailers and, of course, the telcos having to spend quite a lot to keep services going?
It just explains to you that the cost of doing business continues to go up, let alone that we've seen energy prices going up. We've got this whole issue now about load shedding. I mean, as you are saying, people spending over 2 billion in 2 years, that's quite too much. People losing trading days, that's affecting their bottom line. So it just shows you that we could be doing better, and this impact of load shedding are very serious, and unfortunately, we're gonna have to deal with them for quite some time. So it's just very worrisome.
All right, Makwe, let's leave it there. Thank you so much for your time. That is Makwe Masilela, who is from Makwe Fund Managers, giving us the latest when it comes to market developments and then touching on what I believe is going to be an ongoing theme, especially when it comes to the biggest companies in South Africa having to spend a lot more to keep the lights on, especially as the energy issues intensify.